So the title for today is Not Settling for Average, celebrating 20 years of SPIVA. Thank you again and a very warm welcome to everybody who's dialed in. This is a joint webinar or a webinar hosted by 10x, but featuring guest speakers from S&P Dow Jones Indices. So most of you know S&P, very well-known and established index provider. I was just getting the updated numbers this morning, which I found astounding. They've got $22 trillion that are using their indices or benchmarked to their indices around the world. So in our local terms, that's almost 400 trillion rand. Of that $22 trillion, 15.6 trillion is benchmarked to or using the index of S&P 500 alone. So really, really big established index provider. And you will have heard of their SPIVA scorecard, which is S&P Index versus Active, which is a methodology that they launched 20 years ago now to compare how active managers perform versus the market or versus their benchmarks. And it's something that we as passive providers reference a lot in South Africa. So let me introduce the speakers. So I've got Tim Edwards from S&P this morning. He is the Managing Director for Global and Global Head for Index Investment Strategy. Tim holds a PhD in pure mathematics from the University College of London and has been running the, before he was at S&P, he was at Barclays and at the Royal Institute of Great Britain. And so he's running index investment strategy across the S&P Dow Jones Indices entire product set, US global equities, commodities, fixed income, and economic indices. So yeah, really looking forward to hearing your thoughts and unpacking the SPIVA scorecard methodology with you this morning. And then Chris Rule and I are from the 10x side. You may remember us from the CoreShares, from our previous sort of CoreShares label. CoreShares is now 100% part of 10x. Our combined group runs 40 billion rand under management, and we're in the process of rebranding all the funds. So you will start to see all the funds that you knew as CoreShares start to show up as 10x between now and the end of the year. And so I think it's important to sort of unpack the SPIVA methodology, because I think a lot of people, a lot of active managers have dismissed it as fake news at some point in the last few years. So I think it is great that it's so established. There's 20 years of data, and Tim's going to really bring the credibility to the scorecard if there's any doubts in anybody's minds. But before I start, I think I'd like to maybe just set the tone, and Tim and Chris, please give me your thoughts. We often hear people talking about active or passive, or active versus passive. Is it such a binary decision, or do you believe that there's a way to combine them in a way that gets better outcomes?
First of all, good morning, everyone, and thank you very much for having me. It's a pleasure and an honor to join you, and it's always a pleasure to talk SPIVA. I think your question is very pertinent, and thanks for setting the scene. In short, for those who've never seen it before, what our SPIVA scorecards show is, in very short, that over the long term, not that many active managers will beat a market index in proportion terms. But the consequences of that are manifold. I mean, first of all, not all active managers underperform. So many of them do, but not all of them. And those that do outperform will often can outperform materially. So there is certainly empirical evidence in our SPIVA scorecards to suggest that if you can find an active manager who's able to beat the market over the long term, then they're worth their fees. The challenge is that they can be hard to identify. And it's also true that in different market circumstances, active managers can have a harder or an easier time. So what we aim to do with these scorecards really is to help inform decisions, give people information on where beating the market is easy, if you like, where it's hard, what times it's easy, and what patterns of exposures managers might be taking that's leading them to out or to underperform. We don't ever think the debate, if you like, between active and passive will ever be settled. If you take a step back, there is always going to be a need for active managers on individual securities to help discipline and set pricing. But even beyond that, every investor, when they think about their asset allocation, when they think about their income needs, they're different, and they're going to need to make decisions about their overall portfolio, which are active in nature. What I hope to dig down a little bit more in detail today, and to reference the title of this talk, what the SPIVA scorecard shows, I think it challenges the assumption there's a feeling or a perception in some places that using low-cost index-based tools as key portfolio building blocks is somehow settling for average, that you're just going to get the market average and somehow that's settling for average. And what our scorecards show is that actually an index tracking investment is not just settling for average. In fact, compared to the majority of alternatives, it's often in the top quartile or better.
Thanks, Tim. I mean, just to pick up on that was pretty thorough. I almost want to rewind all the way back to the beginning. And what we're going to show you today is that there is no such thing as a passive investment in the first place. The range of indices, the indice options that are available are so significant that as an allocator of capital, as an asset manager, as a multi-manager, as an advisor, that first decision to invest in an index or in a low-cost systematic investment product is not a passive decision. And so I almost debunk the active versus passive debate right at the beginning of the key decision metric as an asset manager or as an investment manager, insofar as how we drive outcomes is through asset allocation. We know that's not a passive decision. And then how we select and populate asset allocation is through a plethora of investment opportunities available to us, some of which are index-based, some of which are systematic, some of which are smart beta, some of which are active. But there is no such thing, in my very simplistic view, as a passive investment. So I almost want to debunk that myth right at the beginning. And our market, the South African market, and Tim's coming with this wealth of global experience, I want to try and bring some local perspective as much as possible. Our market is even more complex in terms of the passive or the index-based decisions that we need to make. And we're going to spend some time unpacking that. So yeah, it's not a binary choice. This is how do we get the best possible outcome for investors, and our view, my view, is typically by blending various approaches to the problem at hand, which is solving for client outcomes ultimately.
Thanks, Chris, and thanks, Tim. So I think we very firmly moved past this sort of early active versus passive into this world where we're talking about how to blend them, when active, when passive, and how, and actually the distinction, the distinction between the two, as Chris was saying, isn't even as binary as that. Now Tim is dialing in from Sydney, so we better let him go first. So yeah, over to you, Tim.
Thank you. So what I shall do over the next 10 minutes or so, what I hope to do, is to give you all an overview of the so-called SPIVA scorecards. I'll take you through the most recent results for South Africa, which were published a couple of months ago now. That was for up to the year end of 2022. Then I'll give you an overview of the different global kinds of SPIVA scorecards that we're producing, because it's not just South Africa that we've been producing them, and we've actually been doing them around the world and for over 20 years in the case of the US report. I'll talk a little bit about the value of a global approach, i.e. why should investors in South Africa care that we have a SPIVA scorecard in Europe or the US? What insights might you be able to glean from the rest of the world's results? I'll talk a little bit about what, on a very basic level, what's driving these numbers, essentially phrased as, why is it so difficult to beat the market? Isn't it quite easy? And I'll close with just a few observations on the importance of fees, i.e., the actual cost of the products, in determining these results, particularly in some asset classes. So that's the plan. Should take us about 15 minutes or so, and then I'll hand back to our good hosts at 10x. Kicking off, what is SPIVA? So I do hope that a decent proportion of the audience has met a SPIVA scorecard before, but you don't need to. I will tell you exactly what they are. So as mentioned at the beginning, SPIVA is an acronym. It stands for S&P Index versus Active. And the notion is to look at the funds that are available, the actively managed funds, and simply just report how many of those beat the index over various time horizons. You know, how many South African funds beat the S&P benchmark over the last year, 5 years, and so on. It does not contain opinions. It's meant to inform your decisions, and it is led by the data. It shows you where active has been working, where it's not. I'll talk a little bit more about the global reports, but there are a global range now, and they're based on the fund industry themselves. So we will look at US funds investing internationally, but that's in the US report. And we've got covered now South Africa, US, Europe, Australia, Latin America, Canada, India, and Japan. We produce the reports whether the numbers are good or bad for indices, and that's really important. We don't just publish it when we feel like the numbers suit us. And there's been a lot of work over the years to make sure that the methodology is robust. As you can imagine, in every region where we started publishing the reports, there were some disgruntled active managers who sort of came at us and said, "Hey, this is all wrong. That can't be right." You can replicate the data yourself with our methodology if you use the same data sources, and we control for a lot of things that you might think are important. And I mentioned survivorship bias. It's a really important part of the SPIVA scorecard. When you see a number like 70% of funds underperformed over the last 10 years, the sample set that we start with is the funds that were available 10 years ago. And the most common sort of challenge I'd get, perhaps not so much from active managers, but from journalists, will be, Tim, look, read this report. There's a report that says that if you look at all the funds with 20-year track records, they all beat the index. Well, the thing is, yes, they're all the funds that survived to deliver a 20-year track record. And what we've seen in this over the 20 years, that actually funds that don't beat the index tend to be wound up. So it's really important to think about what was the opportunity set at the start of the period. So those are the scorecards. They do more than just that, and actually each report has a sort of rich market commentary talking about what's been driving those numbers and all sorts of additional statistics that are available on the performance of active funds. In summary terms, here are the figures as reported in our most recent South Africa SPIVA scorecard. And these are just summary results. The way that we report them is we report the percentage of actively managed funds in that category that underperformed. So 93 is bad. It means not many beat the index. South Africa is one of the very few reasons where we actually report the statistics versus two different benchmarks. The S&P South Africa 50, and there is another benchmark that we report, which is based on domestic shareholder ownership. Chris is actually going to dig into the whys and the wherefores of South Africa benchmarking. So I'll leave that for now, but I will just acknowledge that the South African market does have its own special features, one of which is that we offer the SPIVA statistics versus two different equity benchmarks. And the different colored bars are underperformance rates taken over 1 year, 3 years, 5 years, and 10 years. And what you will probably have noticed already is that when you look at domestic and global equity, the long-term underperformance rates are relatively high, 93, 70, 96. The short-term bond underperformance rates are actually very low, with diversified and aggregate bonds somewhere in the middle. And this is the sort of the benefit of actually reading the full report, is we will dig into these numbers and give it all sorts of other perspectives. One that I'll highlight in the terms of the most recent South Africa report was we dug into, okay, well, so short-term bonds, essentially money market-like short-term bond investments. There is a relatively, I don't want to say easy, but a relatively common way that one might seek outperformance in that space, which is just to take a little bit more credit risk or perhaps a little bit more duration than is in your benchmark, and you can be expected to be rewarded for that. And so one of the things that we do in every report is report how many beat the index, but also how many beat it on a risk-adjusted basis, i.e. once you control for the level of volatility that's observed. And you'll notice that in the first three categories, the equities, whether you do it risk-adjusted, not risk-adjusted, not a huge difference in the underperformance rates, but in that short-term bond category, it does appear that, yes, fund managers were outperforming, but once you adjusted for risk, that underperformance rate dramatically increased, which suggests that one of the reasons that managers might be outperforming in that category is they're simply just taking a little bit more risk than perhaps you supposed. As I mentioned, the South Africa is one of a range of global reports, and they come in a few different flavors. So South Africa SPIVA scorecard, we talked about what percentage of managers underperform, comes out every 6 months. For larger fund markets where we need a much larger sample size, we'll also do persistence reports. And this addresses the notion of, okay, so some managers underperform, some managers underperform. Can I identify them in advance? And particularly, can I identify them by looking at the funds that historically outperformed or historically were above their peers? Long story short, the persistence scorecards show you that essentially what's written in every disclaimer is true. Past performance is no guide to future performance. As I mentioned, you've also got global SPIVA scorecards that you can look at, covering a range of global fund markets. And the one that only comes out once a year, but the most recent one came out just over a week ago. So I will say a few words about that. Is something called institutional SPIVA. It only covers the US market, but it looks at underperformance rates before and after fees, firstly. And it also looks at the difference in underperformance rates between retail products, i.e. mutual funds, and what we call institutional funds, which is essentially separately managed institutional segregated accounts. There's a different database that we use for that. And it kind of tells you how important are fees and what might an institution achieve. So those are the global. They're all available for you to print out and read. All good bookshops, and they're available for free from our website. So I would encourage you to go and have a dig around. The US report we have been, as mentioned, and as an title of the webinar, we've actually been producing it for 20 years. So there's a really rich library of data, information, analysis. And I mentioned at the beginning, you know, most of the time active funds underperform, even over short-term horizons, 1 year. Here's what that record looks like for US equities and active managers. And you'll observe, you know, on average, you're looking at a number, maybe 2/3, maybe a bit less than 2/3, 60-something% underperforming in most years. But there are years when active managers do have done better. 2009 stands out as the most recent example, but last year was also a relatively good year for active managers, and that's why it's important that we keep producing these reports on a regular schedule, and you can rely on us to show you what's happening, what's working, where. Now, why might you care about how US managers, US active funds are doing? You've only got access to, if you've only got access to South African managers. Well, there's not quite a large enough sample size to do this properly for South Africa, but you can compare underperformance rates in the same category across different global markets. And one example where you definitely can do this is if you look at European-based funds investing in US equities and US-based funds investing in US equities. And so there's 3 time series here. They're all about 1 year underperformance rates, how many managers lag the index. But they're showing you 3 different types of funds. One is European funds denominated in euros. That's the yellow one. The light blue is sterling denominated funds, again offered in Europe. And then the dark blue one is the one that comes from US equity scorecards or US funds. And why they're shown like this on this graph is hopefully this is vaguely convincing for you. The picture is the same. It's the same underlying drivers. They're not on the absolute same level, but the pattern is really similar. And that kind of tells you that there are headwinds or tailwinds facing active managers in general that are shared by all participants as they try and beat the market. That's the potential value in having this global perspective. It also can give you an idea where perhaps we don't have enough categories in the South African market. You could look to the US report to see, for example, what's the record of active managers in emerging market equities. Again, more deeper sample there in the US, so we're able to report the statistic. So why is active management so difficult? Why do we see the numbers that we see? And this is something I could talk about all day. We've got a lot of analysis on this, but I'll try and keep it short. So I'll just talk about three things: professionalization, cost, and the varying opportunity set. So professionalization is really important, and to understand it, you need to go back to the base construction of most of our broad-based indices. What they represent is the capitalization weighted indices, or cap weighted sometimes called. What they represent is it's a tiny copy of all the money invested in the market, right? So if you look at the S&P 500 over time, that tells you the story of all the money invested in large cap US equities. And if one person, one investor is above the market, someone else has to be below, because they can't, this is before costs, because we can't all be above average, and that represents the cumulative total. If one person has made a dollar more than the market, someone else must have provided that dollar. And because of that, is sort of no net supply of alpha is the notion there. But because of that, it really matters how good everyone else is in the market with you. And if you are trading against a bunch of uninformed noise investors, they're sometimes called. A noise investor is someone who reads the financial newspapers and treats what they're reading like inside information, right? If you're trading against someone like that, then it's actually probably quite easy to beat the market. If, however, the average market participant is someone with 4 PhDs, a massive supercomputer, and they're working in a hedge fund with all the data and the analysis, the computing power, and all the nerds that they need, they're much harder to be smarter than. So how professional the market is one feature, and the reality is that over the past 50 years, the markets have professionalized immensely. And don't take it from me. Go to an active management conference, and they'll all tell you it is getting harder and harder to stay ahead. Second thing is cost. This is a really simple one. I might quite feasibly be beating the market by 2%, but if I charge 3% in fees, then that's not much good to you, is it? And the cost of active funds is high compared to most passive funds, and so that's part of the puzzle. And the final piece is the varying opportunity set. There are times when things get very noisy or spicy or volatile in the markets. If you knew in advance what was going to happen in March of 2020 as the global economy is locked down, you could have made a lot of money. There are other times when it's all smooth sailing, and the difference between buying one country or another, one stock or another, one sector or another, is very minimal. And it tends to be when things are all sort of going slowly up together. It can occasionally be when things are all going down together. But there is a varying opportunity set. And so that's not just going to drive results over time. It's also going to drive results in the cross-section, in the sense that, for example, one of the categories where we've seen relatively low underperformance rates persistently over the years is international small cap equities. And I think part of the reason might be that the difference in returns that you might get in two randomly selected small cap global equities is actually pretty wide, especially compared to, say, a fairly narrow, 10-year bonds or long-dated bonds, government bonds. It's not going to make that much difference if you buy one versus another. So the opportunity set varies, and in some markets it's quite narrow. So a few words on each. So first of all, cost. So this is a chart reproduced from a blog that my team put out, called "The Importance of Being Indexed." And what we did, this is only based on US equities. I apologize for that, but it was based on index funds tracking the S&P 500 and our small and mid cap equivalents, the S&P 400 and the S&P small cap 600. And what we did was we looked over time, what were the fees on passive funds? What were the fees on active funds? What was the difference? And so essentially, how much money was being saved by investors thanks to the existence of funds tracking those indices? Now, the statistics are in US dollars, but to give you the headline figure, it's $403 billion in cumulative savings over the past 26 years. That's a lot of money that's been saved by investors or not paid in costs to active managers. And then I'm running out of time, so I'll try and convey my final point concisely. But it's really bringing together two notions. One, the idea of the opportunity set, and the other, the fees. And this is reproduced from, I mentioned the institutional scorecard. So if you would like to go into more detail on it, it is available for you to download and read. But the notion here, so the institutional scorecard looks at the difference in underperformance rates before and after fees, right? And that difference is plotted on the y-axis here. And on the x-axis, so along the bottom. And on the y-axis, you have the range of fund returns that we observe. This is IQ range, interquartile range. Like, what was the difference between a fund that was in the top 25% of all funds and the top fund that was in the bottom 25% of all funds? What was the difference between a good fund and a bad fund? And we've identified the equity and fixed income categories differently with these little yellow triangles and blue squares. But the point really is about that relationship in markets. There's, by the way, top left, the one right up there is one of them is international small caps. In markets where there's a really high dispersion, where there's a big difference between winners and losers, fees aren't really going to make that much difference because the rewards to your insight are much more material, and they will easily cover, or potentially easily cover, whatever management fees. In other markets, in fixed income in general, and the ones all the way to the sort of bottom right, include leveraged loan funds and include narrow categories like municipal bonds in the US. A lot of the opportunities to add value, the difference that you're going to get in making a great selection is actually really small. And you can actually see in the most extreme example, an 80% difference is actually a category where the vast majority, 95% of managers outperformed before fees. But when you took off fees, because their performances were also similar, the vast majority underperformed, and the number completely flipped around with an 80% difference. So from 95 to 15%. So in short, that's what SPIVA is. That's what it tells you. That's how you might think about using it and taking advantage of the global range of reports. And those are some thoughts as to the drivers behind those numbers, which hopefully gives you an idea as to whether or not over the long term, those numbers might continue over the next 20 years as they have looked over the last 20. And with that, it's back to, I think, you, Michelle, and I shall stop sharing my screen.
Thank you very much, Tim. So I'd encourage everyone to use the Q&A tool. We're going to take Q&A at the end after Chris's presentation. So if you have any questions that spring to mind on Tim's presentation, please feel free to pop them in the box. And while Chris is busy getting his slides up, so Chris is head of client solutions at 10x Investments. He was one of the original founding investment gurus at CoreShares, and he's been he's been responsible for all our benchmark selection and the products that we've brought to market to date. So I think most of you know Chris. So over to you.
Thanks, Michelle, and thanks to everyone for joining. Tim, thanks for that. That was really interesting. I really enjoyed the piece on professionalism. I think it's a really interesting concept, and the competitive environment that I see out there is certainly intensifying, if anything. And these are very intelligent individuals running active houses, and yet the numbers and when you look at the statistics, they certainly aren't improving in any structural way in favor of these active houses. So it's a really interesting piece, and as you pointed out, the critical role of active management and this competitive professional environment is price discovery. We're hopefully getting closer and closer to a point where where ironically markets become better priced and more efficient, and then there's potentially a stronger argument for indexation. And I think that's the natural tension that exists in asset pricing, and certainly in the US, you've seen passive run up to almost parity in terms of how much assets are managed relative to, passive versus active, index-based versus active. In our market, we're a very long way off that. We're only about 6% market share in the indexation-based approach. But yeah, so thanks, Tim. That was fantastic. Today, I really want to tell a bit of a story, just provide some context and perhaps give some guidance on what we see going forward in the index world. And to start the story, I really want to talk a little bit about South Africa's history, and the legacy equity market that we have in South Africa is one that has very unusual characteristics. And you actually have to rewind all the way back into the late 90s to unpack exactly, what was happening. So, prior to 2002, JSE did a partnership with FTSE out of the UK to start running a formal index series. Prior to that, our indices in our market were actually run by the Actuarial Society. But predating the FTSE JSE series as we know it, and then the subsequent entrance of S&P into our market, we had this Actuarial Society calculating our indices, and we had a few events in the late 90s that really set the stage for what is a hugely divergent beta environment in South Africa. And essentially that is our large, at the time, were these large SA corporates who had great success over many decades prior to that. And as a function of some of our exchange control regulations, and as a function of various apartheid regulations that were pushed down from us from the global markets, we had these like bulging corporates, Anglo-American, SAB, Billiton, to name a few, and they had accumulated assets internally in our markets as they had grown because of their inability to look outside of our borders to invest. And in the late 90s, we saw all of those companies, almost without exception. You see SAB, you see Anglos, you see Billiton, the unbundling of Richemont and BAT. All of these were effectively moving primary listings from the JSE to secondary listings onto various global bourses, but predominantly the London Stock Exchange. Now, this is really interesting because it's effectively a change in domicile, and from an index-based approach, what it really means is that these counters should not be included in South African indices. But we know, for example, breweries is a homegrown South African story. That is an employer of significant amount of South Africans and a large corporate in our market environment. And so it created complexity in how indices were calculated in terms of how we dealt with exchange control and foreign limits, and really sets the scene for what we then see as a very divergent beta. So 2002, FTSE does a partnership with the JSE. They start calculating the all-share index. And what we see very quickly is that Billiton and Anglos, which are these large mining houses, they consume and become very concentrated exposure in what is the all-share index. Now, the all-share index at the time simply weighted based on free float market cap. So essentially, the bigger a company is, the larger its weight is, and that looks at its total shares in issue at a company level. So the market sort of got their heads together and they said, well, there's these big concentrations in these two counters. Those two counters were making up, say, 40% of our local index. How can we deal with this concentration? And interestingly, the response to that was, well, we're going to create a new index series. It's going to be called the SWIX, the Shareholder Weighted Index Series. It's mostly going to be used by institutional investors because there's liquidity in these counters, and because it's more representative of our local market. So we're going to create an index which looks effectively at the South African shareholder register of each of these companies. That is straight, so it looks at the straight register, and we're going to weight these companies by their number of shares held in straight or on the local shareholder register. And was fantastic. It really dealt with the concentration risks around these dual listeds, which at the time were dominant in our market and had a large component of their shareholder register offshore. And so off we went into the sunset, and from that point out, you saw a slow migration of investors away from all share towards this shareholder weighted index, called what we know as the SWIX index, what S&P calls their DSW, or their domestic shareholder weighted index. So this was fantastic. Then the SARB had a look at this and they said, well, hang on, we're effectively externalizing a large piece of our market. And because these counters, these dual listed counters, are considered local, we're opening up an arbitrage in terms of companies coming inward listing or secondary listing, raising a lot of capital from our institutional and very large and established pension fund market, and circumnavigating our effectively our exchange control. And so in 2011, there was a large review from SARB, from National Treasury, and they created a rule which effectively exempted our secondary listed counters on our markets prior to 2011, and any secondary listings which were foreign domiciled or foreign primary listed, that inwardly listed into the JSE post 2011 didn't actually get that exemption. And for the use of indices, they had to use their shareholder weighted index. So effectively, you had to go and look, okay, well, which component of this share is actually listed in our market, and only allocate that portion of the share of the shareholder register to that index weight. So this is very unusual. This kind of directive from SARB and Treasury to say, hey, guess what? When you're calculating an index, this kind of share you can deal with like this, and this kind of share you can deal with like that. That is very unusual. That is very specific to South Africa. And you can ask the guys at S&P, it creates absolute headaches for index providers in our market. But so we've got this very strange case-by-case legacy. But by the way, I'm almost not even going to go there with Richemont, but it's worth saying that up until recently, Richemont, which was one of the largest shares in our market, was not actually a share. It was a depository receipt. So that is even a step further in terms of some of the strange characteristics of our market. And so the outcome of that has been, we've got a very fragmented beta market. And you can see here, we've been mapping the index or the benchmark environment. This takes the CISA general equity category. And we've been trying to understand who tracks what and who thinks what is their index. And you can see here, there's very little consensus on what South African beta is. In other words, if you go out to the market and you say, what do you consider as our reference point for SA equities or the equity risk premium in South Africa, there's there's not a homogeneous answer. If you go to US, for example, you're probably going to get S&P 500 as a large cap reference for beta from 90% of participants. If you go to the UK, you're going to get FTSE 100 and so on and so forth. So this is very unusual, and it's as a function of this history of dual listeds, of shareholder weighted index, of an exemption rule that was incorporated in 2011, and then that legacy has created this environment. So what we are seeing is people starting to move towards domestic shareholder weighted or SWIX weighting, but certainly not the majority of the market. Certainly, if you look at how fragmented it is, it's not a simple picture, but it creates problems, and this creates problems for allocators to beta. I believe it's one of the reasons why index take-up has been less fast in our market, or has been slower in our market, but it has created complexity for decision makers, and really this complexity is proven, and the risk of allocating to beta and choosing the wrong beta is shown beautifully through this return variance graph. Now this looks at our free float S&P SA composite. This is like the all share versus the S&P DSW domestic shareholder weighted versus SWIX. Now what you can see here is that there is and has been substantial return differentials between these two indices over the last decade or so. And this is calendar year returns, so it's by no means perfect. But let's say you're an allocator to beta, you're an allocator to index-based or passive, and you just happen to choose domestic shareholder weighted, and you decided not to go for the S&P composite. Those were the two indices you were going for. There was, in 2021, a 7.7% return differential in that decision. That let's call it alpha of composite over DSW, is more significant than most alpha you'll see anywhere else in the market. And so there's been massive return variance. So the decision and the complexity around beta in our market has been, in the main, a legacy. And what we want to show you on a forward-looking basis now is how actually we're moving to a more homogeneous beta environment. We're moving to a converging beta environment, and we believe one where the allocation to indices becomes a simpler decision. And we think, you know, at the core of your investment decision making, one of the value propositions of beta is simplicity and transparency. So why has this variance existed? I mean, we spoke about the legacy, but what you can see is substantial sectoral biases when you've chosen SA composite over the domestic shareholder weighted indices. Now, if you think about what these indices actually mean, the composite index looks at total free float, and the shareholder weighted index looks at our local register. So what this really means is when you're buying the composite, you're buying more of the shares which have dual listings, and you're buying less of the shares which are only listed on our markets. And so how that's played out in our market in the last 15, 20 years is that an investment in the composite or the all share relative to investments in the SWIX index has meant you've been overweight materials and you've been underweight financials. And that's kind of been a structural sectoral bet that you've taken when you've allocated to those relative indices through time. And you can see fairly consistent, and there's some change, and this is obviously what we're going to talk about. But ultimately, this has been a decision at a structural sector level that you have been making as an investor when you choose all share over SWIX or composite over DSW. That sectoral bias can also be shown in a different way. And this is I love this graph because it really shows how active the index decision has been in our market. And right in the beginning, I said there's no such thing as a passive decision, and this really shows it. So again, this is the decision of picking all share versus SWIX or composite versus DSW. And this looks at a measure called active share. Now, active share, most of you will be familiar with, but essentially it looks at the difference in the individual holdings in the two different indices. And in absolute terms, and divides it by 2. So the highest your active share can possibly be is in this calculation methodology 100%. That's where you literally hold nothing relative to your reference index or your reference benchmark. And active share has a direct translation or is a great forward-looking indicator of what your tracking error is likely to be. In other words, what is your variance of return relative to that benchmark? So if I almost go all the way beginning to that return variance graph, active share is a great measure of saying, well, in the future, we actually should be expecting quite substantial return variance relative to our index because there's such difference in holdings ultimately. So the active share on average through time has been around 25% between the two indices. Now, to me, that's mind-blowing. If you go into the world of active management selection and you say your reference benchmark is the all share, to have an active manager with 26% active share is a relatively high active share. It translates into a tracking error of around 4%. If you look to our CISA category average, the average tracking error, and it changes through time, of course, but is somewhere between 2 and 3%. So this difference between the two indices historically has been more active than the difference between an index and the average active manager. And what we're seeing is a substantial decrease. Now, it's in a similar way we've seen a substantial decrease in materials and a substantial decrease in the deviation of weight between financials. We've seen active share, as of the last rebalance, drop to 9.5%. So what's driving this? What's driving these similarities? And it comes all the way back to the beginning of the story. It comes back to this strange, nuanced dual listings with exemptions, and then therefore the difference between shareholder weighting and free float weighting. And because our market is small and concentrated, we can actually explain these variances through a handful of counters. SAB, the transaction with AB InBev, meant it lost its exemption status. We then saw the dual listed variance between the two indices drop 6%, which is effectively proportionate to the SAB weight when AB InBev took over. Remember, AB InBev was primary listed offshore, secondary listed in our market. And because its secondary listing in our market didn't have the exemption attached to it, its weight in the market substantially reduced. And that was the SARB directive that said, well, you must use shareholder weighted weighting now. BHP Billiton actually restructured their entire business last year. So we saw a substantial reduction there. And recently, Richemont has restructured away from that ADR, that depository receipt nuance, to an environment where Richemont is now dealt with as a secondary listing in its true sense without an exemption. So what we're seeing is the variance between sectors reducing, the variance between or the active share reducing, and explained by these large concentrated single stock events. So what we're expecting, and what we've been expecting for the last few years, if you've been following our beta benchmarking updates we do annually, is we are hoping for a converging beta landscape. For us, it's extremely important. It simplifies the decision to beta, to allocate to beta. There's less allocation risk. Did you choose this index or that index, and then it underperformed, both of which are SA beta. Beta, we believe, is probably becoming more representative of our SA economy. So from an asset allocation perspective, where everything starts, an allocation to SA equity is purer in the sense that you're getting more allocation to SA incorporated companies. And this comes at a time with a liberalizing Regulation 28. So Regulation 28 moving all the way out to 45% has meant that I would make a fair assumption that less local investors are concerned about Rand hedge stocks, what we call our Rand hedge or dual listed stocks, and holding a proportion of them to increase diversification. They can now actually go and hold a global equity portfolio in lieu of the liberalizing Reg 28. So beta is converging. It's harmonizing, as some of the index houses are putting it. In other words, SWIX and free float is becoming more the same. They're becoming more similar. The only meaningful variation between them is now Anglos. In my view, still problematic, because ultimately it means your decision of SWIX over free float is now hinging on Anglos, which is crazy. But I know there's a lot of work happening in terms of market consultations just to try and harmonize these two indices to try and simplify them. So we expect beta to converge, be more representative of SA, and it comes at a time where we've got a liberalizing Reg 28, which means we should be less concerned about dual listed Rand hedge shares, where we should actually be looking to diversify in a meaningful way to global assets. And just to kind of round it off, this idea that you're not settling for the average, in our view, notwithstanding all of this complexity around the SA beta landscape, what we show here, and this is a long-term graph, but you can pull up rolling numbers and stuff, which are often not helpful, but an allocation to any of these betas has been a good allocation relative to the general equity category. And so it shows the importance of having an allocation, a meaningful allocation to equity, and one that is low cost, that is well diversified. And so we pull up this is a long-term representation. If we pull up, well, what's happened in the near term and where how above average has the betas been, or these different betas. Here we look at 1 year return divergence across this is our whole CISA general equity category. Top performing fund 24%, bottom performing fund -6%. Here's the average 13.3. This is the median, actually, more accurately, fund return. What we can see is over this 1 year period, all of the betas, if you want to call them that, have performed above the median consistently. So if you pull these on rolling basis, we believe we've got structural problem in our market. We have a concentrated market. Last year was Richmond. Before that, it was Naspers and Prosus. Before that, it was Anglos and Billiton. There will always be concentration risks. So a capped approach to our market makes a lot of sense. But the return divergence is quite notable. Now, Tim chatted about return divergence in the context of costs. I want to talk about return divergence just briefly in the context of manager risk, and understanding that the importance of this allocation of these consistent betas, and this is over a 3-year period, how they are consistently that 2/3 number in the top third of the market, the top quartile. Here you've got the top 50, which has been consistently in the top quartile since inception and all the way back in 2015 now, creates a fantastic tool for investors when they're making an asset allocation call. What you want is exposure to that asset class, and that's what this shows, is that an allocation to beta really gives you that asset class exposure, and minimizes the risk. Sure, you may have picked, this is a cumulative return, by the way, the manager that really shot the lights out, and that active skill exists. We're not denying that. But chances are you're going to have selected managers that return less than beta. And ultimately, your asset allocation decision should be hinged on what beta is going to deliver. So to kind of conclude, we see beta converging, which is fantastic, we believe, for the market. We see manager risk, and this is not just in the equity category, but divergence in return from an allocator's perspective means potentially more manager risk, more opportunity. Yes, perhaps to select the managers performed extremely well, but also to select that's performed very poorly. We've got a concentrated market, so we need to deal with it in a very explicit risk managed way through capping. We believe is the way forward. S&P actually, FTSE, interestingly, introduced their first capped index in 2016. S&P had done that before, and we really like that methodology, which is why our sort of flagship SA Beta, it has been capped since prior to our headline indices, the FTSE guys capping, and consistency. The market is not the average. What we're seeking out here is a consistent allocation to something that is above average, and that consistency through time compounds and really adds value to client portfolios. So sorry, I think I've taken a bit too much time, but that about wraps it up from my side and opens to questions.
Thank you, Chris. So we've got a few minutes to take some questions. Please feel free to use the Q&A tool. And yeah, I want to also just take this moment while you're thinking of your questions to thank both Chris and Tim for their time and for their presentations today, and also Sher and Bhavna, who are in the background, our marketing gurus from S&P and 10X. Thank you for all your efforts in helping this webinar become a reality today. So we've got a couple of questions coming through. Obviously, yes, this is a webinar, so the recording will be available afterwards, and we can provide the slides too. So we'll send an email around afterwards with all that information. Just a comment from Michael Fredericks. Awesome presentation, Chris, especially the history. A question from Michael Chadbourne. Thank you, Michael. Since the GFC, we've been in an interest rate environment where all boats float higher. That interest rate environment has ended, potentially allowing a market where the cost of capital is material. Do you think that could change active fund outlook? I guess, Tim, that's a question for you.
Sure, I'll take that one on, and hopefully I won't surprise or alarm anyone by suggesting that I answer it with data, right? I mean, that's the the great thing about having 20 years of SPIVA scorecards is we can go back and we can look at the last time or the last few times that interest rates have been on upward moves and say, well, what happened last time? And also look at, the real thing there about, the cost of capital increasing is it's a greater divergence of outcomes, right? Which is implicit in the lifting all boats, right? Some boats will do well, some boats might sink. And that gets into that notion of opportunity, the opportunity set that we talked about. And so, the intuition is with higher dispersion, with a wider range of outcomes, there will be a bigger difference between winners and losers. But it is important to note there is going to be greater opportunity for embarrassment, just as much as there's greater opportunity for outperformance. That being said, here's the so we showed this slide earlier. This is the year-on-year. The US has the longest record, and probably it's sort of well known enough that people might follow along when I say interest rates did X, Y, Z. So last year interest rates came up quite sharply and quite dramatically, and have continued into this year. And actually, it was not a bad year for active. 51% underperforming. I anticipate that number will go down this year, but we'll see. Then before that, you may remember the phrase taper tantrum. The Fed actually lifted rates up from zero, starting in sort of end of 2015, early 2016, and they managed to get rates up to 2 and change before COVID came and hit. And over that 2016, 2017, 2018 period, you're just seeing really typical SPIVA numbers, 2/3 underperforming. The last time before that, there was quite a dramatic interest rate hiking cycle that went on between around 2004, ending in 2007-ish. A bit of a mixed bag, really. Some good years, some bad years. And obviously, early 2000s, very high dispersion, kind of typical SPIVA numbers. I think to summarize what we see there in the granularity of the data, it doesn't seem to be the case that you get just an absolute regime change, right, in those historical occasions. And I think it does conform with the intuition that I suggested at the beginning. There'll be greater opportunity, but there will be perhaps also, as well as getting a few big winners, there'll also be people who are on the other side of those bets, if you like. I hope that answers the question.
Thanks, Tim. Yeah, so I mean, what stood out for me was that number that you had, the 10-year number on your S&P 50, South Africa 50, that had eaten 93% of the universe of managers. So I think we've definitely solved the question. If today was to prove that picking an index is not settling for average, I think we've hopefully convinced the audience of that, and also that if it's not active versus passive, it's when active, when passive, and even in those situations, which passive. So I'm glad that, Chris, you told us it's getting simpler and it's converging, so that's certainly good news. But even all the various indices that you showed us on your graph, that they were still all above the sort of median of the fund range, and also which active. So there are some active managers who very very strongly outperform the market, but the question is to find them. And so even from my side, the different investors that we've worked with over time, some of our investors would like to use an index strategy for South Africa because they feel that the market is quite small, very well known, everybody has the same information. It's hard to find outperforming active managers in this market, and then they'll look for active managers offshore. And then I've got other investors that are the complete opposite. So they feel like they know our market the best. They know which are the good active managers. So they use active management for their local equities. But in the global space, they don't feel like they have an edge in choosing active managers there. So they'll use a benchmark and index strategy. So I think there really is a way to combine the knowledge that is contained in Tim's data with figuring out what the individual investor's strengths and area of expertise is, and then come out with a better investor outcome by combining these different strategies. So I don't see any other questions coming through yeah, and Michael said, thanks, Tim. That was a great answer. So yeah, thanks again. If you think of any other questions for either Chris or Tim, you're welcome to email me. And thanks again for dialing in, and thanks everyone for your time.